DSCR loan is hands down the best thing that ever happened to the mortgage business. It gives real estate investors the opportunity to finance purchases and do refinances off of the market rent and not off of any type of other documentation. If you're still looking to buy or refinance your investment properties using tax returns or W-2s, you're missing out on your fast track opportunity to real estate riches. I'm Andrew Russell, owner and founder of RCG Mortgage. I help home purchasers buy the home of their dreams, and I help those looking to refinance, save money, accomplish their goals, and improve their financial position. So to grow my business and my brand, I've done a ton of networking in my day. I was actually at this super cool white party out east in the Hamptons, and I met this awesome realtor. I didn't think there was ever gonna be opportunity for us to do business. And we exchanged information. I stayed in touch, obviously over and over. Hey, I'm the best, I'm the fastest, I'm the coolest. Give me a chance, one of your clients. Finally, one time I had to answer the bell. They reached out and said, hey, Andrew, listen, we got to keep this kind of on the low, but I have a super high net worth client. You probably even know who it is, which I did. They're famous. And we have this big opportunity for a two-pack, meaning they could buy two different properties from one owner. It was actually someone passed away, and this realtor had a fast track to a great deal for this high net worth client. So one property was in the Hamptons, very expensive. I mean, you're talking, seven-figure sale price properties, high seven-figure. And one was actually in Montauk. So it turns out this purchaser, who will go, of course, nameless, for whatever reason, the previous year had a lot of losses on their tax returns, although they made a lot of money W-2. And the rental properties that they owned, there was a lot of losses, there was a lot of work to them. So just doing mortgage calculations using, tax returns and W-2s, it just didn't work. There were deposits put down for both these properties, I think something to the tune of hundreds and hundreds of thousands of dollars. And this famous person was getting a sweetheart deal on both of them. So I said, oh, this is perfect. What bank were they going to? And it was a big bank, of course, it always is, right? So it turns out it was the wrong mortgage product for them because of the losses and all the documents. So I brought up the concept of the DSCR. So it turns out what they were buying both of them for, they were putting 50% down on both of them, on both of the purchases. The market rent, so all we were gonna go off for a DSCR purchase, the market rent on that loan sizing versus the payment with that loan sizing. So the market rent versus the payment totally exceeded it. They even allow Airbnb. There's all sorts of cool incomes to make these loans qualify DSCR. And they went from thinking these sweetheart deals that we're gonna have to buy in cash, which they didn't want to do, to being able to finance and get the mortgage for both of them just doing the DSCR purchase. We came in, we saved the day. They were just using the wrong mortgage product. And man, when I tell you it's as easy as a credit pull, what's the market rent? It qualifies, cool, ship me over the contracts, order the appraisal. Appraisals came in, forward us title, and there you have it. That celebrity bought within 30 days those two amazing properties, and they straight up wouldn't have been able to qualify if it wasn't for reaching out to our team. Now I hear what you're saying. Andrew, why do you always make it seem like it's so easy, bro? It actually is. A DSCR purchase is based off of what's your credit score? That person's credit was phenomenal. What's the market rent? Obviously, realtors know that. What's the actual payment for that mortgage? And do they have enough money for the down payment, which is, 20, 25% or more? It is that simple, folks. Sometimes they want you to be not a first-time investor. There's ways around it. But unfortunately or fortunately, people just don't know this. It's an education play. It's that simple to qualify. And of course, I hear the haterade from the bleachers. Hey, Andrew, clearly the rates are so much higher. At certain times, depending on market conditions, the interest rate could be 2% higher. But that was only for a small period of time post-COVID when these programs were taken off the shelf during COVID and then came back. So we have found the gap between a DSCR purchase typically and a conventional situation. We might do a conventional purchase with all that documentation and just not qualify, is only a 0.5% to 1% difference. Now, that is not all that much. It sounds like a lot. And it's like, well, why would I take a loan with a higher rate? When I tell you this celebrity jumped out of their seat on a Zoom to tell me, thank you, Andrew, for that mortgage we were able to do for them with that extra 1% in rate, they were so elated. So if it's good enough for them, I promise you it's good enough for you. All right, so let's do this. I want you to see in my eyes, under the hood, exactly what it takes to apply. Let's even use this example of these properties that were in Montauk and the Hamptons. To apply for the mortgage, what it takes to qualify, what are some current rate indications, meaning what does the current payment look like? So come on, let's go take a peek. All right, guys, here we are, the mortgage product of the year, DSCR loan, behind my eyes, under the hood, what it takes to apply, what it takes to qualify. Let's hit it. Now, let's use the example. Of course, wasn't the real name, Johnny DSCR. But let's use the example of the purchase, one of the two purchases that they weren't able to qualify because of tax returns. It just wasn't enough to get them there. I was making all this money, and what it looks like on the DSCR. So the sale price was actually $3 million. They were putting down 50%. So we're going to put a 50% down payment. So their credit score is actually a 740. So let's price it real quick. We're going to go into Loan Sifter, which is the amazing tool that us brokers use to see where interest rates are falling for our clients. We have a $3 million sale price. We have a 50% financing, $1.5 million loan. Credit score is a 740. We're going to go to an investment. It was a one family. It was all the way out east. So let's call it 11787, Suffolk County, in good old New York. We're going to do, sometimes they have prepayment penalties on these, meaning if you pay it off within a year, 2, 3, 4, 5 years, it's acceptable. There's just a small penalty. Now, this person wasn't going to pay it off, so we gave them a 3-year prepayment penalty. We're going to use a DSCR for pricing, of course. Now, the DSCR coverage, what does that mean? Does the market rent cover the mortgage? So on a one-to-one basis means the rent equals the payment. It's a little bit higher. We're just going to use that for now and just see for now we're at prices. So there you go. Today it's at 6.625, which is super low. So, and again, for all the haters, hey, Andrew, rates are so much higher. They're not. I just showed you 30-year fix is pretty much in line with even a primary purchase. It's an exceptional rate. So we're going to use a 6.625 rate. We're going to plug in some homeowners insurance, which has certainly gone up in New York. So if you're at $3 million, let's just use, could be high, right? Let's use $800 a month for insurance. Property taxes for the Hamptons isn't all that high. So it's going to use $1,000 for this property specifically. So there you go. So now when we did the appraisal, the market rent actually came in at $15,000. So what we check is, this is the payment, guys, right here, $11,000 and change. So as long as the rent covers this payment, which the $15,000 does, then you're good to go. It's actually over 125% coverage, meaning that the market rent is over 1.25 of the payment. So technically, if we plug that in, I think pricing improves. So if this celebrity wanted to buy today, that's 6.625. Ooh, it goes down to 6.499. See? Because the rent is so much higher, it's such less risky. It's less of a risk. So because of that, rate's a little bit better. So here you go. Final payment on this program. It's actually about $11,280. That $15,000 covers. So again, we have a $3 million sale price for our good friend Johnny DSCR, our celeb, putting 50% down all their own funds, $1.5 million loan. Didn't qualify because tax returns had so much in expense. They just wouldn't have qualified. In general, got denied. You have $800 a month for your homeowner's insurance, $1,000 a month for your property taxes, and $11,280 payment. The market rent, we did the appraisal, came in for $15,000, and it's that simple. So as long as this payment right here, as long as that 15 grand is at or above, which it was, there's even a lot higher. We got them a better program in our software. We got them a better interest rate. They qualify all day long. Actually, you know what I'm going to do, guys? I'm going to put in the description below our DSCR playbook. Click the link, get the playbook. It's free. It's going to give you all the details on it. And you know what? I think that it makes sense because the DSCR, it's a wild acronym. You're like, Andrew, what the heck does that even mean? There was a great article written by Lindsay Van Summeren. We're going to just take a quick peek at it, guys, right? So I want you to fully understand, why is your boy Andrew saying this is the mortgage product that's taking the world by storm? What is it? And what's a nice and slow down explanation of it? You know, she does a great job here. So DSCR loan is used by individual investors to buy residential homes for investment, of course. Now it's an investment, meaning you can't move in, folks. That's a primary, and that's a big no-no. It's called occupancy fraud. If you buy an investment and you move in, it's a big, big, big no-no, big red flag. So investors, investment, that's the word, several reasons. It's easier to qualify than face income limitations, which we went over, as we just showed. You know, they're going to vet your income when you buy real estate.
In this program, it's off of market rent. They're easier to get approved. Rather than evaluate your personal income, we're going to look at the income potential for the property. So understanding it, guys, again, DSCR, if you never heard of it before this video, I promise you, you're going to go and have dinner with your family, like DSCR, what does it mean? Debt service coverage ratio, cash flow potential of the property, and it's calculated. The debt service coverage ratio is the operating income, which is the rent, divided by the monthly payment. And as long as that equals 1 or higher, you, my friends, are in business. So in calculation, the net operating income refers to how much you're earning in rent. We base that off of the appraisal. So when you are buying a property, in the case of this celebrity, they're in contract. They apply with us, the mortgage broker company. We send the loan to a lender for initial approval, and we order the appraisal. The appraiser is going to go to the property, and they're going to calculate based on what type of property is and what the local area is commanding for rent, what the actual market rent estimation would be. So how much you're earning in rent, minus, of course, the overhead expenses for repairs, maintenance, all this good stuff. This is how we calculate the coverage ratio, which has to be a 1-to-1. It's that simple, guys. Is the market rent going to cover the mortgage? Yes or no? And by what extreme? If some lenders look for a 1.2 ratio or more, which means, say the actual mortgage payment is $3,000. If you multiply that by 1.2, it's $3,600. Now, as is the case currently in this market, they really don't look for a 1.0. And there are some lenders, if it's not at a 1-to-1 ratio, meaning if the mortgage payment's $5,000 and the market rent's only $4,000, they're still willing to lend. They may require you to put more than 20% as a minimum. Oh, I definitely don't want to earn $500K with no monthly payments. So I'm going to care about my offer, but thanks anyway. $2,000 a month of expenses. If your payment's $1,500, the ratio is 1.3. We've kind of touched about this, but like I said, guys, it doesn't even have to be over a 1-to-1 ratio. It could be less, and the lenders are that aggressive right now that they just want you to put a little bit more money down. So it differs because there is no debt to income ratio, meaning we're not checking your income. We're not checking your debt based off of that income. That's not something that we're going to look into. We're just literally just going to, and it's like, Andrew, why is this so simple? Because right now, I guess with whatever diligence they're doing in the secondary market, these type of loans are paying on time. When a loan pays on time as a whole, and from a macro perspective, investors love doing them and offering them out to mortgage companies who offer them to mortgage brokers, who then offer them to you guys. So for whatever reason, these loans are paying very well. And so with that said, they're just very aggressive with both the interest rate offering and the guidelines, which again, guidelines are typically right here, typically 80% or less. Now, some lenders offer 20% down or more down payment requirements. Some actually offer higher, an 85% loan to value, or means 15% down. That's the requirement. Honestly, those that offer the 15% down, even some offer 10% down instead of 20% down, the rate is so horrific, it just makes sense to put the 20% down or more. Typically, they're used for 1 to 4 unit residential properties. Of course, non-owner occupied, as we said, guys, very important. Definitely don't want to move into it. It's a big no-no. They're now offered for 5+ unit properties, mixed use, condos, super cool. Credit scores, it's a little bit lower than a 680. I've seen a 660 get the job done, maybe even down to 640, 620, but that means this 80% number may come down of what they'll lend for you. Now, of course, those celebrities putting 50% down, they only wanted to leverage half the property, but as long as you have typically a 680 or more, it gets the job done. Everyone's different for loan amount. Some lenders just don't offer loan amounts that are lower than $200,000. As a broker company, we have access to lenders that offer very low loan amounts, but typically you'll see the average loan amount is $100,000 or more. And the experience, this differs lender to lender. A lot of lenders don't offer first-time lenders, so you actually have to have experience owning an investment property. That actually changed. Now they just want to see you own a property in general, so you own your own primary. Why? Think about it. If you don't own a primary and you're buying a property with this loan vehicle, there's a chance you might be moving in because you don't own a property. So why wouldn't you move into it? Now that's occupancy fraud, which is a no-no. So they're going to want to make sure that you at least own a property typically to do a DSCR. Some pros, of course, they fund very fast, which is the truth. I was able to fund that loan, I think, in a matter of weeks for that celebrity, which is real cool because we're not going through a lot of paperwork that takes a lot of time. The loan program options are a little bit more diverse, meaning purchase, refi, fixed, variable rates, cash out refis, all that stuff. But most people opt for the vanilla 30-year fixed rate, but there are other options if you want. And the underwriting is very flexible because you're just not looking at all that stuff. Now, cons, they do want to see your money being used for the purchase, typically cash reserves. Now, what's a reserve? So a reserve is, say your mortgage payment's $5,000 a month. Follow me. The mortgage with tax and insurance is $5,000 a month. Every month of that you have left in the bank is called a reserve. So 3 months reserves is 3 times that 5,000. If you have 15,000 to your name after closing, that's considered 3 months reserves. Sometimes they want you to have 6 months, 12 months reserves. And that's because, again, they're not looking at your income, looking at the property. They want to make sure that you have a lot of money left over in the bank. Typically, it could be a con because you want to make sure that investor has that. Down payment, really, you're going to want to put at least 20 or 25% down. Less than that, the rate is very bad. And some people just say, hey, listen, Andrew, I want to buy and start buying investments in a portfolio, but I only have 5 or 10%. It's not going to do it, unfortunately. It's non-owner occupied financing. Again, beat this on your head. FHA is for primary loans, for instance, where you have to move in. DSCR is for investment. You cannot move in. You can't live in one of the units. If you do that, and you get caught, it's a very big no-no. It's considered occupancy fraud. That's a very bad word. Some properties are not eligible. So like agricultural properties, that'd be for more USDA loans, manufactured homes. Some multifamily housing with more than 4 units is popular now, but sometimes down payment's a little bit higher. These are property types that are sometimes not eligible, but honestly, every month as we're progressing, they're becoming more and more eligible, believe it or not. So when is it a good idea? If you want to buy your first rental property, you own a house right now, or your 50th, it's a potent, amazing choice in a lot of scenarios. It helps self-employed borrowers, sometimes self-employed borrowers or people that bought their primary home, changed their income mode after, and wouldn't be eligible for a full doc loan, something looking at their income. It's great for them. Or you're an advanced investor. Typically, you're someone that does private money or rehab loans. And these type of loans are usually 1 year, interest only, certainly not the best terms. It gives investors, seasoned investors, safe 30-year fixed rate options. It's the best loan. There are some other alternatives. You could always do a home equity loan or a home equity line of credit, and from your current primary house, leverage the cash and the equity to buy. You could also do a home equity investment, getting some lump sum options. But regardless, as our girl says, final thoughts, investing in real estate is an important tool, guys. But for many people, this DSCR loan offers the best, the most flexible loan option. It's the best loan right now on the market. It's taking the world by storm.
All right. So as you guys just saw, through my eyes, under the hood, what it takes to apply for a DSCR, purchase or refi, what it takes to actually qualify, and what payments and all the different options look like. We actually have been getting a lot of feedback that we want to see from a full non-QM product suite. What is each one? What does it take to qualify? And if you could just make the math simplistic. So in our next video, non-QM, the math simplified, we're going to show you all the different types of non-QM products. And on a whiteboard with a Sharpie, my favorite thing outside of my kids and the Jets, of course, we're going to write out each scenario for you and what it takes to qualify. We're going to make it simple.